Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's streamrg.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. I'm excited to announce our upcoming schedule of Planet MicroCap showcases, our investor conferences showcasing the microcap community. We will be hosting the Planet MicroCap Showcase virtual on December 6th through 8th, 2022, and we'll be back in Las Vegas for our in-person event on April 25 through 27, 2023. Attendance for both events are complimentary for investors. Expect to interact with microcap management teams, insightful keynotes and panels, plus network with your fellow microcap crew. Registration is now open for our virtual event on December 6th through 8th, 2022. So to join us, please go to www.planetmicrocapshowcase.com. Now, for this episode of the Planet MicroCap Podcast, I spoke with J.Dennis Jean-Jacques, founder of Ocean Park Investments and author of the book 5 Keys for Value Investing. Dennis has more than 20 years experience as a professional investor, and prior to founding Ocean Park Investments, he worked with legendary investors such as Peter Lynch and with the late Michael Price. Dennis extracted many lessons during those experiences and went on to write a book titled 5 Keys for Value Investing. Dennis hasn't done a ton of podcasts, so I'm very excited for you to learn more from his experiences as well as his investing strategies at Ocean Park Investments. Thank you again for tuning into episode 241 of the Planet MicroCap Podcast, and please enjoy my conversation with J.Dennis Jean-Jacques. This episode is brought to you by Stream by AlphaSense. You can find them at streamrg.co/PMC. That's streamrg.co/PMC. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream is unlike any other transcript libraries. Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.co/PMC. That's streamrg.co/PMC. Welcome back, everyone, to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And joining me today is J.Dennis Jean-Jacques. He is the founder of Ocean Park Investments as well as a value investor. Dennis, thank you for joining me today. How are you doing?
Great, and happy to be here. And thank you so much, Robert, for inviting me.
It's my pleasure. I was really thankful that we came across each other on LinkedIn, and once we got to talking, I just thought we had to do a podcast interview together because one, you haven't done a lot of shows, and right. And I really want to give folks a full scope of your background because you've worked with some investment legends, many of whom everyone you're about to hear about now, and I'm excited to hear about the stories with them, as well as authored the book 5 Keys for Value Investing. So I wanted to start up with your background. As we prepared for this interview today, we talked a little offline. You grew up in Boston. From your formative years, how did you get interested in investing?
Yeah, sure. No, so let me give you, a little background and also, how I got hooked onto investing. As you mentioned, I grew up in Boston, and as back then in the early, in the 80s and 90s, Boston was kind of like the money management town, so to speak. I was an engineering student in college. As a matter of fact, one of the first shares I owned was a company called Digital Equipment Corporation, which I don't know if some of your viewers, the older viewers probably remember. It was run by a guy named Ken Olson. He was basically a very brilliant person back then. So back in the early 1990s, I used to use a lot of their products. There was a product called the Digital Unix operating system, which I was using as an engineering student. And during my sophomore year in college, I basically attended my first annual meeting at Digital Equipment Corporation. I saw how ordinary, investors, ordinary people would basically question management, challenge them on certain things. And they were owners of the business. And basically that's how I got hooked to investing.
Very cool. So then, once you got hooked, did you know, okay, this is what I want to do for the rest of my career? I want to be in finance and investing in some way, shape, or form. And if yes, which clearly yes, what was those next steps that you took to get you on that path to where you wanted to be?
Yeah, so the first thing I did when I basically got interned at a company called Franklin Portfolio Associates. They were basically a quant shop in Boston. What they did was they wrote code, and they wrote the code in old languages like Fortran and things of that sort. And so I would write code to basically pick stocks. So I'd interned there one summer, and one of the managers told me that I was actually really interested in the businesses themselves. So a lot of these quant managers, they don't really know what the stocks and the businesses do. And so he thought that was the best place for me was a company right across the street called Fidelity, and he thought that would probably be the best place I should go if I want to learn more about businesses.
Oh, so, okay. So you went to this little known shop that, nobody on here has ever heard of before, Fidelity. All right, let's start. How was your experience over there, and what did you do there? And yeah, just give us the whole thing. What was that experience like?
Yeah, working at Fidelity was phenomenal. I think the experience there taught me as much about myself as well as investing. I had the opportunity to work with some amazing people at Fidelity. Catherine Collins, Peter Lynch, Jeff Vinnick, and several other PMs like Jeff Ubben, who has done. They have done so much great things going, in their careers. But I also noticed very early on that there was not really one way to make money in the market. Each portfolio manager had their own styles that fit their personalities. Basically, every lesson was about, when I was there, was about self-awareness, to choose basically investment styles or to choose the kind of things that would basically fit my own personality. And one of the key lessons I've learned early on is basically to choose the kind of style or choose the arena that basically fits the way you are wired as a person. My natural temperament must match the way I plan to invest. Looking back, it takes a lot of work to find out who you are as an investor. The market is it's a very unforgiving place to try to find out who you are. And when volatility starts flying around everywhere, like it has been this year, that's not the time to really find out who you are. And you, at the core, you want to basically know, are you an investor or are you a speculator? Do you trust your data source? And what work did you really do? The market could be a very testing place. And at Fidelity, I knew early on that I was not a daily trader, and that certain investment styles fit my personality and my temperament. And I think that was the best lesson I learned when I was at Fidelity.
Absolutely. Okay. So who taught you that? Was that Lynch or was that Ubben or Vinnick? Who, while you were there, what kind of access did you have to some of these legends? Were you able to go to lunch with them and ask them as many questions as you could? What was that like?
Oh, absolutely. So the way it was set up is that I was in the kind of associate analyst kind of program where you would basically work on an idea or two, or maybe three or four. You were given a certain industry, and all the portfolio managers, you had access to all the portfolio managers. So basically, my job was really to pitch each manager on my ideas. So I would go to one person's office, and he or she may like a certain kind of company, maybe low PE, maybe fast growers, maybe company with a strong balance sheet, and another person, portfolio manager right next with the office right next door, may like something totally different. Maybe they don't want companies that are not growing X or Y. So you had to really understand the personality and the kind of style that each portfolio manager was operating under, so you could be able to communicate your ideas properly to them. And that's what I realized, that there are several different ways to manage money. There are several different ways to make money in the market, and not one portfolio manager was like the other. In addition to that, we would have industry reviews where we would pitch, we would cover a sub-segment of an industry, and we would have a meeting, basically, talk to everyone about what we've learned. And around the room, you have 30 managers around a table, and here you are pitching or talking about your ideas, and different kind of questions will be thrown at you, and you have to be ready to answer them. And depending on the styles that they have and the kind of things they're looking for, you have to be able to adjust, and you have to be able to understand your companies well enough to communicate that to them. So that's one of the things I learned, is really about that there are different types of investors, there are different types of ways to make money, and you just have to know that style has to be aligned with your temperament and also how you're wired.
100%. And we're going to get there, because I want to learn more about, your what type of investor you are. But I mean, look, we're going to continue on with the story time a little bit, where I have to ask, I mean, in those pitch sessions, what was the best feedback that you got from one of these legends when you were, pitching a particular stock or pitching a particular industry? I mean, give us a couple stories there, because I'm sure you've gotten some feedback that you'll never forget.
Well, I think the best feedback is often when you don't get a feedback, to be honest with you. Sometimes you would talk about a company that you're probably pretty excited about, and you don't really get you don't really get a reaction one way or the other. And so you really have to understand, why was I so excited about it, and this particular manager who have X amount of experience in the markets didn't really see what I saw. And a lot of times it's really about how you communicate and how you present the companies and how you present the opportunities. And this goes against to what I said earlier about really understanding how the particular manager, or how the particular manager is wired, and what they're looking for in a particular investment. So that was basically the biggest lesson for me, is really about how do I understand a company well enough that I could talk about a company to 3 or 4 different type of investors and really get all 3 of them, all 4 of them really excited about it. And also, while doing that, you're also making sure that you don't miss any holes. For example, one manager may like really strong balance sheet and strong cash flows with a history of beating numbers. The other person may not care as much. They really like the companies to be really cheap and really cheaply priced. So, so if you could have 4 or 5 different managers really like your idea, it's by and large probably going to be a pretty good idea, because they look at the companies from different angles.
Very good. All right. So, obviously at the beginning, I introduced you as a value investor. At one point or another, you're definitely going to come across Warren Buffett at a certain point. So for you, how and when did you finally come across Warren Buffett, and what kind of impact did he have on your career?
Yeah, no. So, it was almost like it was almost fate that I would run into Warren Buffett, and running to him really kind of altered or changed the trajectory of my career. During the time when I was at Fidelity, back then there was no emails or anything of that nature. So I wrote a letter to another legendary investor called John Rogers at Ariel. At that time, I think Time Magazine had him on a list of like under 40 people to watch or something of that nature. So every time John would come to Boston, I would kind of have lunch with them, things of that nature. And he gave me the advice to read up on Warren Buffett. I basically went, all in. I think for me, Buffett's plain speak and temperament really resonated with me. I remember reading about how his office was much more like a library than a trading floor, that you wouldn't even know if the stock market was even open if you ever visited him at his office. And, after Fidelity, I went off to Harvard Business School. And sure enough, during my first year at HBS, Warren Buffett spoke to my class. And an interesting story. So, during the class, I'll never forget this. During the class, he posed a question that I will never forget, and that really changed how I thought about the stocks in the market, and basically altered, the decision I would make about my career. Buffett asked, basically what he asked is that he asked, why would someone sell a perfectly good business, generating lots of free cash flow? Why would he sell that business at a 30 or 40% discount? Then he said, well, perhaps, I don't know, perhaps this person must get out of the stock, or maybe they may think that they're able to buy it back cheaper at a later date or a more convenient time. But then Buffett asked, what if you buy those shares at that time and you don't sell the shares back to them? What if you don't sell it back? What if you hold on to these shares at a great price? You hold on to it for months, years, or even decades. That is the opportunity to buy good businesses at great prices. Sometimes, as I learn more about Buffett, he talks about how, you have to take advantage of market volatility and not become a victim of it. The market was not built for business buyers. They were basically built for traders. The market was not built for value investors. It was built for people who want to get in and out of stocks. And every day, the market will poke at you to do something, to buy something or sell something, or buy something or sell something. And during that time when he spoke to the class, I call it my rational awakening, because that's when I started looking a little bit deeper into value investing. So I think that's how Buffett really had an influence on the direction I would take.
Wow, that's a really cool story. I'm assuming you've been to Omaha now at least once.
Yes, I have. As a matter of fact, in 2000, when everyone was saying Buffett is done, this is during the internet bubble, I actually got up and basically thanked him for visiting HBS that year. As a matter of fact, there's a YouTube clip on it, if you would Google it. And I thank him for visiting HBS, and I told him that story about how it was basically my rational awakening, and that he was basically he was pleased by that. So yes, I've been to several Buffett meetings, and look forward to more to come now that COVID is over.
100%. Yeah, I got to get out there one of these years for sure.
Oh, you got to do it. I'm not making predictions, but you should do it sooner rather than later.
Yeah. Well, you just turned 92. But
we're in the back nine.
Yeah, for sure. Well, okay. So clearly, you're a value investor. Value investing is in your blood. That's what you love. That is core to who you are as an investor. So you actually ended up writing a book about this, and titled 5 Keys for Value Investing, which is still available wherever books are sold. And, for you, what was the main idea of the book? Why did you want to write this?
Yeah, that's a good question. Yeah. So, it's interesting because I basically wanted something that I could use. When I was in business schools, they're really big on frameworks, right? Everything's a framework. Everything's a 2x2 framework, and I didn't really see a framework that's that's like a graph or things of that nature about value investing. So I really wanted to create something that I can use going forward, that was born from investors that I really, really respected. So it really started as a faculty sponsored research paper during my second year at Harvard Business School. What I did was I re-engineered several investments made by managers that I highly respected. I looked at investment made by Warren Buffett, Richard Rainwater, Michael Price, Seth Klarman as well. And I remember, some investments. I remember looking at, Sanborn Maps. Sanborn Maps was a company that Buffett made. He wrote about it in I think his 1962 shareholder letter. He talked a lot about that company. I looked at the Sunbeam investment by Michael Price. I looked at the 1994 investment by John Rogers in Safety Clean, which now became Clean Harbors. Carl Icahn's Tappan company that he invested, and also Richard Rainwater. I mean, the Crescent REIT that he did, and also Mesa. So there was a whole bunch of kind of companies. There were dozens of companies in situations like this that I basically tried to learn from. And the main idea for the research project was to come up with questions that these investors might have asked themselves at the time of making those investments. I try to figure out what was the economy like, what were interest rates, what were the financial news of that time, of that period. And I basically came up with about, 200 questions in total that these investors might have asked when they were making these investments. And I wanted to have a checklist so that I could use myself. Okay, well, just go through this checklist and then you can make good investments. But the list was too long. It was like, 200 plus questions. But I noticed that those questions fell into 5 different buckets: business, price, value, catalyst, and margin safety. And that's how I came up with the 5 keys of value investing.
Very cool. All right. So here we go. Let's, maybe the abridged version. What can you walk me through what for you are the 5 keys to value investing?
Yeah, sure. I mean, so let me summarize the 5 keys. So basically, the list of questions could be summarized into these 5 areas. So the first question is, is this a good business? And what I noticed that a lot of different managers or investors would define good business differently, right? So, but that's the first question. What is a good business? The second question is, why is the market offering me this price? Is the industry out of favor? Is it a turnaround? Is it a bad company? Is a company losing market share? Whatever the case may be, but I need to understand, why is the market offering me this good price? Why is it selling me this business? The third question is, what is the company worth in a normalized kind of circumstance? If those things that I believe were to go away, what is it worth? If the stock's trading at $10, is it worth $30 or is it worth like 15 or 50? So I need to really figure out what the company's worth. The fourth question is, what's going to catalyze that company from $10 to 30? Are they breaking up to 2 different pieces? Are they launching a new product? Are they reducing their debt? Are they buying back a lot of shares? Are they gaining market share? Are they going to be raising prices soon in their products to have a 80% market share that they're really going after the last 20% of the share? So there could be a lot of different reasons what could catalyze a company from, let's say, $10 to $20. But I need to understand what are the possibilities to get at $20. And lastly, what is my margin of safety? Ben Graham. If I buy the stock at 10 and things go wrong, does it go to 8 or does it go to 2? I need to understand that dynamic, because if I buy that 10 and I think this is worth 20, but if I'm wrong and the stock goes to 2, it may not be a good investment. Maybe if I'm wrong, the stock goes to 8 or 9.5 or something of that nature, would be much more pleasing. So I need to figure out what's my margin of safety. So it seems like for me, what I've noticed is that a lot of investors, they would lean more on one area than the other. Like, for example, early on, Warren Buffett would focus on margin safety when he was running his hedge fund. Before he began focusing on business quality when running Berkshire. He's all about business quality now. Before it was margin safety. Michael Price was more about catalyst driven. Sometimes he was a catalyst. He would go in and shake things up. Seth Klarman, margin safety, downside protection. He wrote a book about it called Margin Safety. John Rogers and Marty Whitman, I noticed they love good businesses at cheaply priced. So they like the business and the price. That was the thing that kind of got them really excited from what I could tell. But in addition to that, the insight I think that often is lost on people was that they executed this strategy very, very well because the investment style fit their personalities. In other words, how they were wired. So, for example, as much as I think about how smart I am, I cannot be a day trader, or I cannot trade crypto, for example. For me, I need a business. I need cash flows. I need assets to analyze. And this was a lesson I learned very early on. I think that was a lesson that while doing this project, I learned is that all of these styles fit the personalities of those managers that I was running. And that was the same thing I saw early in my career when I was at Fidelity as well.
Absolutely. And I have to ask, of the 5 keys, are these in, just some random order, or is it in the order that of importance for you?
That is a great question. And that's the heart of it. So if you, I kind of look at it as, if you look at it, it helps you approach a situation. So, for example, if you see a company that you think that, oh, this is kind of interesting, and you just kind of go through the 5 keys. Now, sometimes one key may be more important than another. For example, let's say it's a turnaround. The company has issues. It's going through a lot of stuff. There's new management coming in. They're trying to sell some assets. Maybe margin safety is most critical in that situation. If it's a Fortune 500 company, maybe it's a monopolistic kind of company that's been around for 50 years, maybe margin safety is not as important as the quality of the business or what would catalyze this company to reach fair value. So the 5 keys really allows you to, how do I approach a situation and how I try to figure out which is most important at that time. One of the things I learned as well is that you cannot overanalyze everything. There's usually 1 or 2 key things that's going to really get the stock price going to make money on the stock price. It's usually 1 or 2 things. And what you want to do quickly, you want to figure out what are the 1 or 2 things that's most critical to getting the stock price up. And typically it's one of those 5 things that you should focus on. It may be a great company. It may be a great balance sheet, good management fee, but there's no catalyst. So it's probably going to be dead money for a while. Or it could be a not so great business, but they're selling below net cash, and they're going to sell assets. So great catalyst, high margin safety. It's kind of like the whole cigar butt kind of investing that Ben Graham talked about in Lynch's book, Intelligent Investor. So again, it depends. It allows you to assess the situation and you determine what's most important. And I think over time with experience, you get a feel in terms of where you want to specialize. You may want to specialize in quality business. You may want to specialize catalytic opportunities, or maybe you want to specialize just buying companies with high degree of margin safety.
So who would you say this book was written for? And the reason I want to ask this question is because I feel that, especially in the last 2 years, there's been a lot of new people to the market, to investing. And it's been a lot of, maybe not so much thinking about what your strategy is, or, maybe just kind of following some trends, or maybe, in some cases, just throwing a dart, right? But throwing a dart winning is throwing a dart losing too.
Right, exactly. Yeah.
But, so from your perspective, and this, it's not like you wrote this book yesterday. This was written a while ago. Who is it written for? And would you say it's still written for that same audience?
Oh, that's a great question. So the 5 keys was basically written for business buyers of public companies. Now, I have to stress business buyers. I'm not saying stock pickers, business buyers. It's really for the active owner where of businesses where either you're a novice or professional. So it's really about, how do I understand and analyze a business? How do I buy a piece of business that just happens to be trading publicly? It's not so much a stock picking book as opposed to a deep fundamental value investing book. So having said that, it's not really a step by step, but perhaps more of a way to approach companies. As I mentioned before, basically because when I was writing the books, I wanted a practical framework that could basically withstand the test of time. There's only one edition. And as you mentioned, it's been around for over 20 years now, and it's been published in 5 languages, so it's doing pretty well. But the key was really to make it practical, and hopefully could stand the test of time.
Very cool. All right, so again, book is available wherever books are sold. So
yeah, I have a copy right here.
Oh, there you go. Nice. All right, I got to get my copy.
Exactly.
So my next question is, you brought up working with Michael Price, that you were a protege of his. But by the way, rest in peace.
Yes.
He's no longer with us, unfortunately. But during your time working with this legendary investor, what were some of the key lessons that you remembered from him?
Yes, no, he's he was a great human being, and he mentored a lot of people like myself when he really had to. Even when he went to semi-retirement, we would meet in his office when I had questions about companies I was looking at, or had questions, and he would always take time. I think the last thing he did was having my daughter shadow him in some of his professionals in his office before he passed away. This is maybe a year before he passed away. So, it was the investment world has definitely lost another legend. But working with Michael was basically how can I say, was basically walking into a research boot camp with new daily lessons every day. But you mentioned you asked about lessons. I think a couple of lessons come to mind. I think the hardest part there was very working there was really about remembering some of the minute details on every company you covered. How many shares of the CEO, how many shares the CEO owns, what, has that changed the past year, or when was the last time, the company presented to the street, so, every little detail, he expects you to have that on top of your head, and know the company's inside and out. But I think the overarching lesson was what we learned is that to basically do the work that others might overlook or basically don't want to do. He would often say, if you do original work, go through the stuff that no one else would be willing to do, you basically be ahead of the game. And I truly, truly believe that. There's a lot of, work that, that people overlook or it's too more mundane for them to do. And a lot of times that's when you find that you get an edge or you get an insight that a lot of people may overlook. So I think that was the overarching lesson, is really about, do the work that other people might overlook or not want to do. Another lesson, which is kind of funny, is that, is really he taught me how to read the Wall Street Journal. I remember, him waving me over his desk. I think it was like maybe the first week I was there. And he told me, come over here, let me teach you how to read the Wall Street Journal. And I thought to myself, wait a second, I did graduate high school, I know how to read, but then he began to speak. He asked me about, where was the change happening in the companies that you're reading? Where was the craziness? Where was the craziness happening? And that really started me when I look at and read different periodicals and financial rags. I start to think about where's the change happening? Where's the craziness? I remember during the pandemic reading about companies paying other companies to take barrels of oil, off their hands. I don't remember a couple of years ago. Not today. They can't get enough of oil. So it's things like this where you say, this is crazy. And that might be an opportunity. And lastly, another lesson I would also mention is that he would say that activism is not a tool. It's not a strategy. It's a tool. Don't go out seeking out low quality companies that needs help. Basically seek out good companies on their way to being great, and, you know, engage if you must. But I think oftentimes, even today, you see a lot of these, you know, activist strategies. And I say to myself, you know, it should be a tool and not really something that you go out looking to do. It should be something that you buy a good company, a good piece of asset, and, you know, maybe something went awry and maybe something had changed. And you should be willing to, as an owner of the business, to be able to be a little bit more engaged or give advice to management. And I think that's probably the best way to go about it. And I think that's a way to pursue it. And I was very fortunate to have been involved with several kind of restructurings when I was there, from, you know, the sale of Maytag to Thermal Electron, so on and so forth. But again, these were good companies that we invested in, and over time we had to become more engaged. But I think those are the lessons that I learned.
So Dennis, thank you for that. That's incredible insight. I'm definitely going to be really listening to this part of the, I mean, I'm going to re-listen to the whole thing, of course, but definitely probably going to play back this part for sure a few times, because those are some great lessons there. So now let's catch us up to today. You know, you're the founder of Ocean Park Investments, but before we get into the fund strategy and whatnot, you know, what are some of the areas of opportunity that you're seeing right now?
Yeah, look, I mean, Robert, I mean, you mentioned micro stock. I think you're going the right direction because, you know, in today's market, we're trying to seek, you know, in the OMAHA strategy, you know, doubles and triples in the coming years. And I think that we're looking at a lot of opportunities in today's market, which, you know, needless to say, there's a lot of companies out there that are cheaply priced and that could be home runs. But you're right. So never I thought I would be in a small mid-cap podcast, you know, because I kind of focus on these big mid-cap companies, and Michael did actually invest in small and mid-cap companies as well. But, you know, the reason why this is interesting time for me and why I really wanted to talk to you and some, you know, in your audience, obviously, is because some of these mid and large cap companies, they have fallen over the past several months to about, you know, to small cap or semi mid cap kind of capitalization levels. Some companies never what I thought would be in those kind of levels. So basically, as in terms of opportunities, what we're seeing today, we're seeing a lot of great opportunities. There's a lot of great companies that have just been fallen. There's been basically baby been thrown out with the bathwater, so to speak. So because we specialize in industrial-related companies, these are companies with hard assets and cash flow. So we're seeing a lot of things in the electrification of everything. We're seeing a lot of opportunities, logistics, energy transition companies. We're seeing a lot of things in, changes in energy storage and transmission, precision agriculture, and zero carbon kind of materials. I think it's going to be big. So there's a lot of great companies that have done it well, gaining a lot of market share. But the market has kind of thrown them out, and they're at small, mid, micro-cap levels. And so we're very, very, very excited for this opportunity. This is the time I think that people should be putting capital to work.
All right, so let's learn about one potential way they could do that. Like we've been talking about this whole time. You run Ocean Park Investments, so tell us a little bit about the Ocean Park OMAHA Dislocation Fund. It sounds different than maybe some of the other fund names out there. But what would you say makes it different?
Yeah, so many people are not familiar with a dislocation approach, but it's a critical part of being a good long-term investor. So OMAHA is a dislocation fund because it has what we call a 1030 gauge. We only release capital when the market is down at least 10% and the shares that we're looking at is down at least 30%. That's a dislocation. So that's a way of quantified dislocation. So if the market's going straight up and things of that sort, that is not the environment for OMAHA. So basically, the reason is because these high volatile environments of panics, uncertainties, present unbelievable opportunities. As equity dispersions widen, market dislocations rise. This creates a very attractive risk-reward profiles for certain companies. We are and I will likely, and we likely will get deeper into this, but we are in this type of environment right now. Omaha dislocation continues to be more of a opportunistic company, and it combines our core competence as a firm, as sector specialists, with speed of capital. And speed of capital is a powerful tool coupled with demonstrated knowledge of a specific industry or specific company. Omaha dislocation basically, it's a opportunistic drawdown kind of investment fund waiting for these opportunities to arise. And that's what we do at the core. We wait for the opportunity. And I think that's what kind of differentiates us from other strategies when it comes to these opportunistic situations.
Absolutely. So, I mean, in times of not dislocation, do you have other strategies that you can then, put some capital to work so that you're not, because these don't happen all the time, right? Between the flash crash and, the V recovery from March 2020, now we're kind of in like the slow burn situation right now. I mean, okay, that's kind of 2 events in the last 3 years, but still, usually doesn't happen that often.
Right.
Okay.
Right.
So is that, do you have a strategy that is for those non-times like this? Like, I think I saw on your website, there's what's called the absolute return strategy.
Yes, absolutely. So it's interesting because when you're running absolute return strategy, you're long and short, and shorting companies often get a bad name, and I guess for good reason, but Warren Buffett used to go around shorting companies when he was running his early partnership. I think a lot of people don't really know that. He did not want to be tied to the market's ups and downs, so he would kind of go short some companies. Now he has private investments that does that. But basically, so Ocean Park Absolute Return, basically what we do, we try to strive for 3 objectives. Number 1, to compound capital, on a risk-adjusted returns. The second is really not to be correlated with the market for bad, for better or worse. The market's up, we may be flat, and the market's down. Hopefully, we make some money. And thirdly is really about downside protection, really preserving capital. It's interesting because during times of unusually challenging environment, what we look to do in terms of downside protection is, at a minimum, we want to match the market or do a little bit better. But in normal environments, we really want to protect capital. In an unusual environment, maybe keep up with the market or do a little bit better. But that is what the goal is for absolute return: compound capital, not correlate the market, and also downside protection. And that's the strategy we use most of the time as we're waiting for other opportunities to arise.
Absolutely. I mean, look, you have to, I think in this day and age, when you're running your, I mean, especially if it's not just going to be microcap focused, you kind of have to be nimble in some ways. I mean,
yes,
I support this thesis in the sense that, looking at some recent investor letters, quite a few of these guys got hit hard.
Yeah.
Real bad. Especially the ones that are a bit more concentrated.
Yeah.
Will they end up being probably very successful in the long run? Most likely, but definitely in the short term, it's sad. It's brutal.
Yeah. It's tough. Yeah.
But
no, I think you're right. I think being nimble and having a holistic approach of the market cycles, and not think things go on a linear fashion, but it's more cyclical, is very, very important. And that's what Oaktree and a lot of the other firms like that always talks about. It's about the cycles of the market.
100%. All right, so I want to ask you a question that I ask everybody on here, but what would you say? And look, it might be from some of these experiences with working with these legendary investors, but what would you say was an investing experience? You don't have to name the name of the company, but what was an experience that really, either proved out your thesis or really helped shape you to be the type of investor that you knew that's the type of investor I want to be?
An investment I did?
Yes.
I would say investing in Maytag. So when I was working with Michael, we had had a position in Maytag. And the reason why I'm mentioning is because it was a long time ago and we don't own any shares of Maytag because it's no longer a public traded company and it's by itself. But we had taken a position. The company was doing certain things that was not to our liking. It was a new CEO. We thought that he would make certain changes. They had some raw material issues that we thought that the procurement wasn't where it should be. Myself and my colleague flew to Iowa, and it was my first time in Iowa, and saw the cornfields and things of that nature. And I remember the company CEO walking me through a plant, and he didn't realize that I was the one who was making the decisions in terms of the company and things of that sort. But when we got to the boardroom, I was really peppering him with really interesting questions. And then I think at that point, he realized that I knew the company as much as he did, or as close as he did. And long story short, Maytag was actually sold to Electrolux. And an interesting note, which this is the first time I'm sharing this, is that Carl Icahn did an investment call in Tappan Company. This is probably in the 80s, early 80s, late 70s. And that was a company I researched when I was writing my book. He sold that company to Electrolux. And I remember what he did, and I remember the kind of things he did. This is when I was in business school, kind of writing the book. I was, as I mentioned before, I was looking at all these kind of situations. So here I am, almost in the same kind of situation where I'm about to sell, encourage the company to be sold to the Electrolux, which was still around. So anyway, I thought that was an interesting kind of full go around. So anyway, so that was something, and the reason why it was an important investment is not so much, it was sold and it was profitable, but it came full circle. When I was researching these type of investments when I was in business school, and these things were so far in the future, will I ever be in that situation? Here I was doing that, and all I was doing, I'm going to sell the same company that Carl did, 30 years ago or something of that nature. But anyway, that was interesting.
That's really cool story right there. All right, so we're right about there. To close this out, what advice do you have for folks listening in here? You kind of given quite a bit of advice already, not just having to do with investing, but also life as an investor. But, what would you say for those that are listening to this saying, all right, maybe I want to be a value investor. Maybe I want to understand this better. Other than reading your book, what are, and some other books and studying from some of the greats, but what can they do to be the best possible value investor or investor that they can be in as short a period of time?
I would say three things very quickly. Number one, you have to find an approach that fit your personality and your temperament. I cannot stress that enough. Don't try to be like George Soros or someone that you just don't. It just doesn't fit your personality. And part of that is really understanding who they are. As a person, what do they like to do? Are they a risk taker? How did they grow up? And you need to find someone that resonates with your background and your temperament and your values. Again, there's a lot of ways to make money. So I think that will be the most important thing. And that will also be the second thing, is the first thing, which is you gotta have the temperament match your skill set. The second thing I would say is really to really study and as much as you can about people who have done what you would like to do before, and particularly in the area and the approach that kind of fits your personality. There's a lot of information out there. You have to be a voracious reader and consumer of information, and you have to basically love what you do. And if you think that this is work, then it's probably not cut out for you. But if you say to yourself, I always joke, I say, what do professional golfers do when they retire? they play golf. So it's similarly. So as an investor, you'd want to do this, for free. What are you going to do when you retire from investing? You probably want to invest. So it needs to be that kind of natural attachment towards the industry. Buffett always says, he skips to work. I skip to work every day. I wake up early, sometimes 3, 4 in the morning, just reading something on a company or reading a 10K or 10Q or something that, I remembered reading about some other company. I want to find out in the footnotes if that's the case. So it's all fun for me. And that's very, very important. And lastly, the other thing about it, I would say, is really surround yourself with very solid people, people you could trust, very honorable people with high values. And I think that if you have those 3 things, you'll be on your way.
Absolutely. Listen, that's why I got into media, because when I retire, I'm just going to keep talking to people.
Right. Exactly. That's a good one. Yep.
So Dennis, with that, where can our audience go and find more information on you, follow you on social media, as well as go find more information on Ocean Park Investments?
Well, I would say I'm not huge on social media, but LinkedIn, please, we have Ocean Park has a LinkedIn page. You can follow us there, and we'd love to have you as a follower, and perhaps we could connect with some of your viewers.
Very cool. Well, Dennis, thank you so much for joining me today. I really do appreciate it. Good luck. Stay safe. And I look forward to our next update.
Great. Thanks so much, Robert. Really appreciate it. Thank you so much. Okay.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.